One. And welcome everybody to a special Web3 Smart Money Circle update. I'm Adam Sarhan. With me today is Pranav Kanade, who's the portfolio manager at VanEck of their digital assets alpha strategy. Pranav, welcome to the show.
Thank you. Thanks for having me.
So you have a fantastic background. I'd love to hear all about it. Can you please tell us how you got to where you are today?
Sure. Happy to get into it. How far back do you want me to go?
As far as you want.
I'll start by talking about maybe the pivotal moments in my life. So when I was 12 years old, my parents decided it would be a good idea for us to move from Bangalore, India to the United States. So we immigrated from, being Bangalore is a big city in India. It's like the IT capital. Moved from there to a small town called Cheshire, Connecticut. Went to middle and high school there. Both my parents are doctors. So, they really emphasized sort of science and math education. So I would say I spent most of my time doing that. Contemplated going into the sciences, could just never get there. I was more interested in the markets. I think like senior of, high school, I got really into biotech stocks, and I started to learn about how to value them, how to think about investing in them, and so on. So ultimately ended up going to NYU's business school for undergrad, went to Stern, majored in finance accounting, minored in entertainment media, did a whole bunch of sort of internships in college. And the thing that really drew my attention was distressed and high yield credit. One of my, I started college in 2008, so right during the financial crisis, and I was graduating in 2011, 2012. And so this is right coming out of the financial crisis, but going into the European credit crisis. And, the ability to kind of look at a capital structure holistically and sort of think about value, and then where the best place to express value and risk was, which is what kind of credit gave you. Was really what drew me to that space. So I started my career at UBS on the credit desk. I was a research analyst doing TMT. Eventually got to the buy side. I went to a firm called Hutchin Capital, which is a multi-strat firm. I was a credit research analyst doing, again, TMT. This is kind of right around 2012, 2013. And then eventually found my way to energy, because energy went through a distress cycle, as you might recall. Energy went from, oil went from $100 a barrel all the way down to 20, created a lot of chaos in shale. So spent a bulk of my career investing in distressed energy, sort of did that pretty well through the variety of commodity cycles. Then became the head of research for the liquid credit investing business at Angelo, which is another large asset manager, and eventually got to Millennium. I was a portfolio manager at Millennium, running a long-term credit book. So obviously none of this says anything about crypto and anything on crypto. First came across Bitcoin in 2015. Being a credit guy and distress guy, you're kind of trained to think about things from a point of asymmetric upside, because, buying bonds at 5, 10, 20 cents to the dollar, you can kind of quantify how much you can lose. And then you can then think about, the upside case in most of these cases. That's how I thought about Bitcoin. It was like call option on something very unique and differentiated. Didn't think much about it. And that was kind of like in the 2015, 2016 timeframe. But then 2017 was one of the bigger kind of crypto adoption waves, all driven by the ICO mania, which was on Ethereum. While, most people got enamored with, what's the hot ICO they can participate in, what drew me to it was this idea of a distributed ledger where applications can sit on top. And the first real use case for that distributed ledger with programmability was the ability to fundraise. It opened up this whole capital raising environment that we'd never seen before. It was kind of like crowdfunding that's global, that's on this permissionless blockchain. That was really interesting. So I dug in deeper in that sort of time frame in 2017, just purely from a learning perspective, really thinking about the possibilities of what kind of applications can be built on blockchains. And then how do you even value them, right? So I'm a valuation cash flow guy at heart. And this is around 2017. There was not very clear valuation models or value accrual models for crypto, all things in crypto. So one of the things I decided to do from that time on was really allocate to other managers in the crypto space and just kind of learn from them. And at this point, it was all largely VC focused managers. And that allowed me to look at projects, look at the space, and think about product market fit and those types of things, but also come up with valuation methodologies. So, right around 2019, 2020, I was able to figure out how to value digital assets in general, or certain types of digital assets. And I started investing alongside the strategy that I developed personally, and eventually got around to telling Jan VanEck, the CEO of VanEck, about it. We met in 2021. We talked for a long period of time and decided that it would make sense to, ultimately raise the strategy around it. And that's what I do today. I manage a digital assets hedge fund at VanEck, and happy to get into all that. I know that was a long explanation about my background, but
I love that.
Journey. Yeah.
That's really good. So you're more of a value Ben Graham type of a guy, Warren Buffett, but you've been able to take your skills, move them into multiple asset classes, from credit to energy, now into crypto, and you found success in every asset class along the way. So my next question is, can you tell us a little about your investment strategy?
Yeah. Look, I mean, at a very basic level, I think about it from the point of return of capital. So if I buy XYZ thing for $1 today, what could I expect that to return back to me in capital, 5, 10, 20 years from now? So it doesn't have to be like a dividend or a share buyback next week. It can be well further down the line, but really understanding what that mechanism is, and then being able to go from that back to what it could be worth today as a result of that return of capital. That's really the simple kind of value investor lens you can take, right? That's been the underlying thing, the underlying approach I've taken to all assets. If you take energy, for example, buying an energy bond, distressed energy bond at 5 or 10 cents of the dollar, you can value the reserves at a different commodity price in the future, and then see what those cash flows are and how those cash flows will accrue to you, the bondholder, well into the future, and then price the bond according to those cash flows. Similarly, you can apply that to digital assets. If you're looking at Ethereum today, just as a simple example, because Bitcoin is different. I would kind of separate Bitcoin from this conversation and put that in a different bucket. Everything else are these cash flowing intrinsic value assets. If you look at Ethereum today, you can sort of think about where it is today, but also think about it into a distant future where there are more applications on top of Ethereum that people are using. And when people use these applications, they're paying fees. And you can estimate what those fees are going to be. And then you can think about the ways that those fees come back to you, the holder of ETH in this example. There's two ways Ethereum returns capital to ETH holders. I'm just, again, using this as an example. One is through a burn mechanism. So they reduce the supply of ETH, very similar to how you think about a share buyback with some nuances. The other one is to the stakers themselves. They get paid a percentage of the fees generated. So those are your return of capital mechanisms. Now, knowing that, you could estimate or model what the fees could be in the future based on different adoption curves and and sort of values. And so you can apply. So anyway, point being, that's been the central framework of how I look at things, which is what's the mechanism of return capital? And then let me model that case.
Got it. And then do you invest, like you mentioned, ETH in projects with the hedge fund, or do you invest in ETH and Bitcoin outright, or altcoins, or how do you actually deploy capital?
Yeah, so we are all in the liquid space, so we don't do anything illiquid. So if you were to quantify the liquid market within digital assets today, it's about 1.1 trillion. 700 billion or so of that is Bitcoin. So everything else is really our focus environments. Everything ex Bitcoin. There's 19,000 crypto digital assets out there. Most of them, in our opinion, are worthless, and they will be worthless in the future. So we're focused on, let's just say, that small subsect of the market that will accumulate a tremendous amount of value if there's adoption for this digital asset class.
Got it. Makes perfect sense. Okay, next question. Let's talk about some risk management. How do you handle risk? What are some timeless lessons you've learned with respect to risk management and mistakes you see with respect to risk management that people make?
Yeah.
And how to avoid.
That's a very open-ended question. So one of the earlier frameworks that I developed, or that I developed working with others who have taught me how to invest in just investing in general, was thinking about investments in scenarios, right? Just probability weighted scenarios. So whenever we invest in anything, whether it's a stock or a bond or crypto, I think about it from the perspective of a downside case, a base case, and a bull case. And there's
say that again. Downside case, base case, and then a bull case. Is that correct?
Those are the three scenarios simplistically I think about, right? So downside case, you typically have an investment thesis, and then you have a framework around catalysts and how that investment thesis will play out. And you'll have KPIs that drive that investment thesis, right? So when it comes to digital assets, I generally think about things in terms of adoption. So, there's X millions of people using XYZ application or blockchain today. And in the future, that will be a much, much higher number. We can estimate what those numbers are grounded in some reasoning and some data, and also how much fees those users will pay and sort of the value they're getting out of it and all that good stuff. But ultimately, all that really boils down to is a set of KPIs that we can sensitize to a downside case, a base case, and a bull case. And we can then assign probabilities around those things. That kind of gives you like a very high level expected value, right? So when things are very deeply discounted to their expected value, that makes it an attractive investment.
Right.
So from a risk management perspective, we have this sort of live dashboard for every one of our positions on what's the down case, a base case, and bull case from a price perspective that's grounded in some fundamental methodologies. And when things are overvalued or undervalued relative to those expectations, that's our risk adjustment sort of signal, right? So if I think something in the future is worth $10 and is trading at $1 today, it's highly attractive. If it appreciates a lot in price, and it's either appreciating in price because our thesis is playing out, or just purely because of what's happening in global macro or the digital asset class itself and those types of things, then we use those as signals to understand how to change risk and how to modify risk. So when things are overvalued against their intrinsic value according to our models, then that's our signal to reduce risk, and vice versa, right? If something's deeply discounted, our thesis still holds, and our thesis doesn't change, that's our signal to add risk.
Got it.
That's at a very basic level, right? But then if you there's multiple kind of facets to it. So one of the things I think, just bringing my traditional investor lens to the digital asset space, one of the things I notice is investors in the crypto space are just eternally optimistic, right?
Right.
They all think everything's going to work out. I come from the distressed world where I'm just mentally trained to think on ways things will not work out. So I try to kind of balance both, which is, this is still a venture asset class. So you do have to put on that hat of, what's the upside case and weighing those more than just thinking about downside, because the downside is it all goes to zero. But it's useful to bring a high level of skepticism because, as I said earlier, there's 19,000 tokens. 19,000 of them are not going to work out, right? Or, vast majority of them won't work out.
Yeah. So that makes perfect sense. So you don't actually make decisions based on price alone. You use price plus your fundamental thesis and your models based on what you feel is below market value, or what's a good way of wording it? Is it market value?
Yeah. We establish what we think something is worth in the future.
Got it. Okay.
And then we weigh the current price against that.
Do you go 12 months? Do you go 18, 24? How far out do you go?
Much longer. So we typically try to value these assets on a 20-30 basis.
Okay. Got it.
So kind of over the next 7 years. And you kind of have to do that, right? So, one of the mental frameworks we have is, as I said earlier, the liquid digital asset space is around $1 trillion, 1.1 trillion in that range. Global fixed income and global equities is kind of 260 trillion. So 260x the size of the current digital asset market. And I say that because I believe that capital formation on blockchains are superior to capital formation in the traditional asset world. When I say superior, I mean it from the sense of it's better, faster, cheaper. So if that thesis is accurate, then over time, you'll see this $1 trillion asset class take market share from the $260 trillion asset class. So given the relative sizes I just mentioned there, you have to sort of think further out in duration rather than think sort of, what's going to be, what's my price target for the next 12 months type thing. Now, we have to weigh that in our strategy, especially against things that will get adopted, right? So there are many things that will get built on blockchains. We as a strategy are hyper-focused on the things that will gain adoption in the next 2 to 3 years, rather than something that might gain adoption in 2029, 2030. Right. So I'll give you 2 simple examples. Real world assets like, private credit moving on chain, that will take some time. That will be sort of, 5 years out, right? Decentralized social, which is an area people love to talk about, like, Twitter and all the social media platforms moving on blockchain and being decentralized. That might happen, but that will be sort of way, way further out. There are 2 areas that we think are likely to be on chain in the near term being the next couple of years. number one is stable coins being used for payments and settlements. And number two are NFTs being used by Fortune 500 companies to sort of change how they do, customer acquisition and loyalty programs and those types of things. So while we value these assets very far out, we're focused on things that gain adoption in the next couple of years.
That makes sense. So it's almost like a Venn diagram where you've got that long term, but you got the small and then you got some overlap. I love that. So, okay, next question for you. What are some timeless lessons you've learned along the way that you'd like to share with the audience?
Cut losses quickly, and be just recognize when you're wrong. The sooner you recognize when you're wrong, that saves a lot of trouble, right? So oftentimes, I learned this pretty early on. You have a thesis and things aren't working the way you expect them to work in accordance to your thesis. It's really good to constantly question your thesis. That's kind of what I learned. Because your natural tendency is to ignore the things that might not be in your favor once you have a position on, because you're kind of hoping it maybe works out or so on. Oftentimes that never works. So just take your thesis and weigh it against what the market is telling you. Very simply, for example, on all our digital asset positions, like as I said earlier, we have an adoption curve expectation. Today 10,000 people are using this. In 6 months, we expect 100,000 people to be using this, and we have a reason on why. We monitor these data points on a daily basis, and if over a period of 30 days things aren't working out like the way they're supposed to, we're debating why that's the case, and we're debating whether we should sort of modify positioning and so on. So I think the point just being, if you identify you're wrong and you can identify it quickly enough and soon enough, then you could readjust and really play offense throughout your portfolio, rather than sort of being handicapped in a position and having to play defense over a period of time.
Yeah, no, I love that. It's interesting because most value people that come on the show, they don't really say take losses. It's more of a technicians use that term or something along those lines. But the fact that you use it's really interesting, especially with crypto and Web3. So, okay, next question.
And the other thing I was going to say is also like being unemotional about it, right? So one of the things, if you spend enough time in the crypto space, you'll notice that people are very tribal, and people have their camps, right? You have like the Bitcoin maxis, you have the Ethereum maxis, and everyone thinks that the thing they own is like the greatest thing since sliced bread. What we try to do is just be unemotional about it, right? The market is the market. Things will get adopted. Like the market will adopt the things the market wants. So our job as asset allocators is to really focus on what the market is telling you from an adoption perspective, and ask whether there are good investments around those types of themes. So again, being unemotional is the other thing that is a timeless lesson for me.
I love that. Those are two premises of my book, of removing the emotions from the decision-making process and then always cutting the losses short. I love that. Okay, next, and we just met, so it's interesting how much overlap there's. What are some timeless mistakes you've made and or you've seen other people make, and how do you avoid them?
Well, I kind of mentioned this earlier. So being a distressed credit guy and sort of looking at the world through this lens of skepticism constantly, my brain is just naturally wired sometimes to just think about all the things that can go wrong.
Yeah.
And as a result, in my earlier career, I avoided a lot of good investments. So as I mentioned, I invested in Bitcoin in 2015, I believe, but just size too small. Because you always think about the things that can go wrong.
Right.
And so I would say, if I were to kind of give advice to myself going backwards, I would say something along the lines of, it's kind of important to weigh the balance between asking what are the things that can go right, and if things were to go right, what's the upside, against all the things that can go wrong. That's kind of been a lesson for me myself. Yeah.
No, I love that. And actually, that was one of my next questions. What advice would you give yourself? So basically what you're saying is, to make sure I understand you properly, is do the due diligence, look at the risk, but don't be consumed by that, because that's like the skepticism or the pessimism side, but also do the due diligence on the reward side of the equation and make sure that you can win and you're properly positioned accordingly. Is that correct?
Yeah, exactly. And I think, especially when it comes to crypto and digital assets, it's very easy to be bombarded by it depends, right? So in the bull markets, the media loves to write about all the great things and, price going up every single day and all that good stuff. And in the bear market, like we've been in the last year, every day is, a new set of negative headlines and why it's all going to zero, right? So it's almost helpful in some ways to sort of turn off that noise, or, it's always good to pay attention to what people are saying and sort of, but really be able to balance that with like what you're seeing in the data, and then sort of putting those things together and asking what are the risks, what are the true risks, and what are the upside, and what's more priced in, right? Because there's an element of what's priced in. So I would say that's been pretty important for me.
I love it. Beautiful. Well, as we go forward, I know you can't speak about specifics, so I'm not going to ask you specific questions, but what is the best way for people to get in touch with you? Are you on Twitter, or go to VanEck.com, or you tell me?
Twitter is the easiest way. I'm at pcan20.
Okay.
So I've been, in my previous roles, I was not allowed to be active on social media. But this one is quite the opposite, because crypto lives on social media. So I've been sort of, getting more active. So at pcan90.
Beautiful. Well, Pranav, thank you so much for coming on the show, and hopefully we'll see you on again soon.
Sounds good. Thank you.